there's a lot of value in making new contacts with brokers and staying in touch with brokers and continuing to build that relationship with them. So when that opportunity did come to us, it was at a price that was slightly too high for us to feel comfortable moving forward, but it was pretty close, and we knew it was close enough to Louisville that we'd be able to manage the asset in a similar fashion. And we just explained a lot of that to the broker, and they were familiar with us and our ability to get things to the closing table.
Yo, what is up, everybody? My name is Matt Drouin. I'm the host of the Go Big Live Real Estate Investors Podcast, the show to listen to and to watch if you are a tired single-family, small multifamily investor that is looking to swim upstream and doing larger commercial deals. I have a part 2 with Mr. Mike Margarella, who's founder and principal of Next Play Investments. Next Play is an established private equity company that focuses on commercial real estate. The company owns and operates apartment complexes, self-storage facilities, and other commercial real estate asset classes. Next Play targets undervalued properties and transforms them into cash flowing assets. The company accepts investments from private investors seeking to invest passively in real estate. It's been about a year or so since I had Mike last on the show. I wanted to bring him back on and catch up and see kind of like what's going on in the marketplace. He's actually was one of my first episodes that we released. I think it was actually episode 13. So hopefully he's going to see some improvement in my hosting capabilities today. So without further ado, welcome to the show, Mike. I appreciate it.
Hey, Matt, thanks for having me. Really excited to be here for a second time.
Yeah, absolutely. And if you're looking at Mike's origin story on my big question of you were born, now you're here, what happened in between, and how he did his first larger self-storage deal, definitely go back and tune into that show. It was one of my absolute favorites. So that being said, what have you been up to? It sounds like things have been slow sledding, as you to use your words, over the past year or so. So tell me about like what you've been seeing out in the market there as it pertains to commercial real estate.
Yeah, absolutely. I agree with that sentiment. I'd say once interest rates started to hike in 2022, 2023, we started to see a shift in seller expectations. And it was just much more difficult for us to get deals to pencil because the price of our debt had increased. And in our opinion, seller expectations had not kept pace with that. So this is the first deal that the deal that you and I have been talking about is the first deal that we've come close to closing on in the past year, just because, it's just been really tough to find middle grounds in what we're willing to pay and what sellers are willing to accept.
So let's talk about that. There's a lot of deal junkies that are kind of like got taken out to the woodshed, and that we've been like kind of seeing the tide go out. But I mean, like, how do you kind of like keep yourself sane in doing that? Because you're obviously, this isn't one deal that you looked at one deal, you just happened to, get it locked up. I mean, you probably were making tons of offers out there on properties. So like, kind of like tell me about the mindset that it takes to be patient and just keep your nose to the grindstone, not give up in the process.
I think you hit the nail on the head there when you mentioned deal junkies. And so we're very long-term minded and we treat things like a business. And that's what I would advise people to do. There's always something that you could do to invest back into your business. So you're right. We've been trying very hard to identify our next deal here in the last year. But just because that specific deal wasn't out there or we couldn't find it doesn't mean that we were doing nothing or wasting our time. So we're doing our best to make new broker contacts, enhance relationships with existing broker contacts, spending a whole lot of time and resources on asset management and ensuring that the assets that we do own were performing as best they could, investor relations, doing our best there to stay in contact with our partners, doing our best to make new relationships, going to networking events, adding folks to our distribution list, and just doing the best we can to further the business one step at a time. Just because we couldn't find an acquisition doesn't mean that business stopped or the past year was a failure. And just doing our best every day to just move the ball forward just a little bit.
100%. I mean, I equate it to making deposits out into the universe. You're not going to get payback immediately. And if you can adopt that mindset of aggressive patience and just do it for longer and with greater consistency than your peers, you will, while other people are, retreating, you're expanding your influence and relationship value out there so that when opportunities do come up, then you are going to be in the most optimal position to hop on them and create win-win situations across the board. So before we get into the Phoenix Apartments deal, because I definitely want to pull on some threads there in terms of like its origin. This is Lexington, Kentucky, and that sort of thing, which is a market I just started educating myself on when I got your email. I wanted to talk about your current assets and like what's been what how is self storage doing out there, because that's definitely a bigger part of your portfolio with the is it the Bigger Garage brand, and just tell me about that stuff.
Yeah, so we focus mainly on commercial real estate and more specifically apartment complexes and self storage facilities. So we do own 6 self storage facilities, 3 apartment complexes, and as you alluded to, we're under contract to close a fourth here in December 2024. And so the past year, it's been an interesting year for sure because obviously interest rates have increased. We've seen a whole lot of inflation. We've seen rising prices across various industries from material and labor to insurance costs. We're starting to see property tax hikes historically start to outpace what we were accustomed to there. So for us, I'd say the main thing that we focused on in the past year is just really honing in on our balance sheet and our P&L, ensuring that our expenses were as low as we could reasonably have them be, and really beefing up our reserves as much as we could. Because, especially earlier in the year, and we're winding back to 2023, I'd say the economy was in a bit more of an uncertain place. So we were doing our best to just buffer as best we could in the event that our resident base ran into some hardship and we saw a bit more delinquency, lost a lease, things like that. We wanted to be best prepared if things did come to that.
So let's talk about self storage. I'm genuinely curious because, at least in my market, there's been a lot of self storage that's been like developed out in rural areas. And I'm talking to my peers on how it's affecting their pricing power on an existing product. So tell me about what's been going on in the marketplace of self storage and how those have been performing and what trends you've been seeing.
I'd say that is definitely an issue both in self storage and in multifamily. There was probably more development than ever between 2020 and 2023. And I think I saw a statistic that there were more starts on both of those asset classes than ever before in 2022. And just the cost of debt was so cheap then. And I think just with the advent of how many resources there are, how many great podcasts and other written resources there are for folks to get started, they would just pick up an asset class, take out some cheap debt, and start to develop something. So I'd say in both of those asset classes, supply and demand is a really important factor, especially in self storage when you're looking at, call it a 3, 5, 10 mile radius. And if there's a significant amount of supply that's being developed 5 miles from your facility, that is absolutely going to impact the pricing on your facility because just intuitively speaking, when a new storage facility opens, you're of course going to see promotions. You're likely going to see very competitive pricing. And for your store to maintain competitiveness, you're going to have to be cognizant of that and consider making adjustments. So for us, we take a model that I think a lot of other operators take, which is we'll be really aggressive on the front end, both with our street rates and promotions that we're willing to offer. But we're also going to be aggressive with our rate management in the future, meaning sometime 6 to 12 months after we might establish that tenancy, we'll look to increase rates closer to market rents. And so once you have that tenant in, usually on the storage side of the business, they're pretty sticky. The average stay time is usually in excess of 12 months and sometimes closer to 18 months. So if you're able to increase rates on that tenant, let's call it 1 or 2 times, you're in a much better spot than you would be otherwise. And that's the business plan that the REITs usually take, and they're very aggressive with it. So a lot of smaller operators do the same thing, and we're no different.
Now, speaking of self storage, I mean, self storage kind of got sexy. I mean, you were definitely in the industry before it got sexy with post COVID eviction moratoriums, and you had a lot of residential investors that kind of like just threw in the towel, like, no, I'm not investing in residential anymore. I got taken to the woodshed, so now I have this self storage shiny object. They've done that, and I've seen a lot of people kind of pile into that space. Has that equated in a increasing competition for self storage assets, and kind of how have you manage that? Have you gotten unsolicited offers on some of your facilities from some of these operators that that are hungry for self storage, that have that are got the residential beating through COVID?
Yeah, I'd say it's definitely had an impact throughout the industry, and I'd say the biggest impact is along the lines of what we just spoke to is development. Not only just new developments ground up on an empty piece of land, but also expansions. So, for example, one of these folks might purchase a facility that's, let's just call it 20,000 net rentable square feet, and then they go and develop another 20,000 net rentable square feet and basically double the footprint. So now, obviously, that's having a significant impact on the supply and demand in the area. So there's only so much you could do about that when it's popping up around you. We try to address a lot of that at the front end of new acquisitions and looking at the supply and demand in the area, and then also pulling any starts that are happening. So we're cognizant of, okay, there might be another 40,000 net rentable square feet coming, and ensuring that we could account for that. I think we're going to start seeing more of a stark impact on that in the coming years here, because as you know, a lot of the debt that folks had taken out was usually in that 5 or so year range debt. And I think a lot of the debt that came in 2020, 2021, 2022, we're going to start getting to the point where it's starting to mature. And, basically what we're seeing just on the brokerage side of things, uh, we're seeing a lot of assets where we wouldn't even be willing to offer what the debt is on these properties. So I don't necessarily think there's going to be a wave of foreclosures or anything like that, but I do think that we're going to start seeing some more reasonable expectations there on the sell side.
Excellent. So parlaying into multifamily, and I was thinking about this before I got on this call, is you've done a really great job of operationalizing the self storage brand. Are there things that you've parlayed in terms of skill sets or tricks of the trade from self storage into the multifamily business? Or are they just like two completely different beasts that have like nothing to do with each other?
No, I'd say they're very similar in a lot of respects. And parlaying broker relationships is a big one. There are some brokers who are more jack of all trades. And sometimes that's where the best opportunities are found, because when you have a broker who's super specialized in storage or multifamily, it's unlikely that they're going to misprice an asset. And it's unlikely that they won't be able to trade an asset for close to what it's worth. But maybe when you catch a broker who is not as specialized, you're able to get in there and pitch them on your experience and your ability to close, and you're able to get that asset for a price that you're a little more comfortable with. And then also on the management side of things, and self storage, we're vertically integrated, so we do self manage our assets. We have an in house call center. We do our own marketing. Multifamily, we do use third party management, but I think that helps us quite a bit from an asset management standpoint, because we're much more in tune with what that all looks like from the property management side. So I think for us, it really helps us keep on top of the management team, contractor team, to ensure things are going according to plan and with a set schedule there as best we can. So I'd say there's certainly some advantages there from really getting in the weeds on storage and parlaying that into to our third party vendors.
You hit on something with the brokers and a product specialization that is absolutely true, and I have to like double down on this because I had a client just recently, a an off like an office multifamily broker brought a retail deal off market to him, and the broker was just like, the sellers want 1.4, but I don't think it's worth that. Like, I'm really not sure if I'm going to be able to sell this thing. And this broker had like no experience within retail like whatsoever. And so my client was able to lock this thing up for like 38 cents on the dollar for what comparable existing product traded for, just from the standpoint of this broker not really understanding what they had. And I think that you know there's definitely the specialists I've gone to that like they price these things like right on the money, and there's no, let's say, market inefficiency to to take advantage of, which is like one of the reasons why I love real estate, is because of the market inefficiencies that do exist, and you can't get those types of inefficiencies while investing in the stock market because you got sort of like perfect pricing efficiency in place. So
And distribution lists too. Like these, if you're dealing with a multifamily broker, they have a vast distribution list for their multifamily asset. But if that same broker, just like you said, comes across a self storage listing, you might be one of one, or you might be one of two or three on their distribution list. So that gives you a huge advantage. And same thing with just residential retail brokers who focus on more 1 to 4 housing. I mean, those are the best types when they come across an apartment complex. They might not necessarily know how to adequately price that. And like you said, there's just a lot of inefficiency there.
100%. So let's switch gears here and talk about this opportunity, Phoenix Apartments. I saw your post on, LinkedIn and Facebook about this deal, and it piqued my interest because I'm not familiar with the Lexington, Kentucky market. Uh, is this a new market for you, or have you done deals in this market?
We own an asset in Kentucky, and so we work with property management in Kentucky. That's in Louisville, which is just about 90 minutes from Lexington. So we're going to be utilizing the same property management team and a lot of the same vendors for Lexington. So in that sense, it's not a new market for us, but we don't own anything in Lexington yet.
So that being said, I mean, how did this deal come to you guys?
It came to us just through broker relationships. So it was sent to us on a distribution list from brokers. It's not an on market deal. So that goes back to what we were chatting about earlier this afternoon, just that there's a lot of value in making new contacts with brokers and staying in touch with brokers and continuing to build that relationship with them. So when that opportunity did come to us, it was at a price that was slightly too high for us to feel comfortable moving forward. But it was pretty close, and we knew it was close enough to Louisville that we'd be able to manage the asset in a similar fashion. And we just explained a lot of that to the broker, and they were familiar with us and our ability to get things to the closing table. So I think those things helped quite a bit in getting us to reach a middle ground.
Absolutely. So, what was it? I mean, we haven't talked about this before on the show, really. Like, what is your typical negotiation style when you're looking at these deals?
Depends how far off we are. I mean, sometimes if we're more than, let's call it 20% off on guidance or list price, it might not be necessarily worth our while to even put in an LOI. And there might be some different schools of thoughts as to how many LOIs you should be sending out. But I just don't always feel comfortable sending out super low ball LOIs. But on a deal like this, we were probably about, I'd say, 5% or so off from where we really wanted to be. So that was a deal that was certainly worth some additional effort to see if we could lock up. And I think usually if we're that close, and especially if I have a relationship with the broker, you just give them a call and run them through your analysis. I think either way, the broker is going to appreciate that. So even if you don't end up locking up that deal, the brokers really do appreciate the feedback. It helps them a lot of times and gives them some ammunition to go back to the seller and say, hey, here's how the market's responding. I really think we need a price adjustment, or I really think we need to consider this offer because otherwise I don't think it's going to trade at what we initially thought. And a lot of times the sellers are just pushing to be super aggressive. So the brokers are almost asking for that ammunition to kind of beat down the seller just a little bit on pricing expectations. So from there, just taking them through the value we see in the property, taking them through how a lender is going to look at the property, at least in our opinion, and where we think a lender would fall on that, and then just going back and forth on some LOI terms, and just asking kind of what's important to the seller, right? I mean, obviously, price is most important for most sellers, but due diligence period sometimes that's important to some sellers over others. Closing in 2024. I mean, we're approaching the end of the year here, so is that important to the seller? If so, can we do that? Inspection timelines. How quickly can we get in and out of a property? Because some sellers just don't want to tie a property up for, call it 30, 45, 60 days, and they want a much quicker turnaround time there. Earnest money, does this seller really want to see some, a higher than typical earnest money deposit just to get a little more security in closing? So just trying to figure out those pain points for the seller, and giving the broker as much comfort as we can that we're the right fit.
So, what's the unit mix on this property?
So there's 80 units at Phoenix Apartments. It's 72 one bed, one bath apartments and 8 2-bed, one bath apartments.
And what do you like about the deal?
So we liked a lot of things about the deal. So I mean, first is location. Like I said, this was fairly close to an existing asset that we owned. we were able to utilize existing property management, existing vendor connections we had, and to us, that's really most important. We're only looking in a handful of markets, and we'd really like to continue to leverage the relationships that we have before we look to expand into new markets. So that checked a box there, and then the metro itself. I mean, Lexington has a ton of population growth in the past 10 or so years, and there's some strong projections moving forward. We really like the median income in the area, just the demographics generally, and then the asset. The asset itself is a mid 1970s asset, but it's in solid physical condition. It's more than 90% occupied and has a strong rent roll. But with that being said, there's a whole lot of value add to it that we think we're going to be able to implement on day one or pretty soon thereafter. And I'd say the best example of that is just utilities. So the electric is separately metered, but with that said, the current owner pays electric for all the tenants. So that's something on day one with new leases, and as leases come due, we're going to start putting in the tenants' laps, and so that's going to make a huge difference on our NOI, and that's not going to necessitate us doing any rental increases or anything like that. And obviously, there's an additional expense to the tenant, but in the market, and I'd say just in markets generally, I think most tenants do expect to pay for at least electric, and we're cautiously optimistic that that will not be received too poorly. So a lot of good things there as far as just the existing NOI and what we think we could do fairly easily just by remedying some management inefficiencies.
Why in the world did the current owner pay all of the electric utilities? That would make me just angry looking at all those utility bills every month.
Well, that's what I said. I almost feel like it's more effort to make those payments than it is to bill them back or just have the tenants pay them. But I think there was probably a little more going on behind the scenes as far as management goes, and our understanding is the owner was more or less self managing. There was an on site property manager, but they weren't utilizing, as far as we know, any professional management companies during their ownership tenure. So I think there's just some inefficiencies that we could capitalize on, and I think for the sellers, maybe they just had their attention on some other assets, and they just have some other goals. And as great of an asset as this is in our eyes, for some folks it might be a tiny asset, and they might have loftier goals. So I think we're just going to do our best to start remedying that on day one.
Now, let's talk about the debt procurement. How is that process in this market, on how it worked in this deal?
Yeah. So I'll rewind back even to last year. Our last deal was actually in Louisville, and the debt market was very challenging. And our main market is Indiana, and we're fortunate that we have a whole lot of local banks and credit unions that we have strong relationships with. So it's very rare for us to have any difficulties procuring financing, but we got a whole lot of backlash in Louisville. Just residency, that was our first asset in Kentucky at the time, and so it was a very difficult process. I'd also say, that was mid late 2023. That was really at the height of our interest rate rises. And I'd say it was also at the height of uncertainty. And there were just a whole lot of banks and credit unions that just shut down, and they just weren't interested in lending at all. And they just kind of wanted to wait things out. So that was kind of the basis that we walked into this deal with, and the expectation that we had. So we're looking to agency debt here. So we're going to have Freddie Mac debt on the property. It's been a much easier process just going that agency route. There's obviously positives and negatives with going that route, but for us, that helped us avoid kind of that local bank and credit union route, and we're working our best to get this closed in the next month.
Excellent. So I researched this deal, and one of the things is that, like, when I first get an address, what I do is I take out my Google Maps in my phone. This is like the first thing I start to do. And the one thing I liked about this deal is you look at it, and you see it's surrounded by a lot of what looks like owner occupant single family homes with in ground pools and very well maintained lawns. And it was like, I was like, that's usually one of the first things I look at is like, all right, what's the surrounding neighborhood? So it looks like this is like one of the few actual like multifamily assets that's around there, and you have, and those homes, the single family homes, are trading for anywhere between like 700,000 to over $1 million right adjacent to there. So the fact that anybody could build new multifamily, they may allow you to build a self-storage facility, but a new multifamily facility around $1 million homes, like that's going to be dead on arrival when it comes to like this, zoning board of appeals. So no, I really like the prospects of the deal a lot. So, Mike, I want to talk more about the deal in the green room with you, but before we do that, um, I would like to wrap up with some advice that you have for those investors that are out there that maybe own a couple of small multifamily properties or single family. I mean, they were like in your shoes, rewinding the clock back years ago. What advice would you have for them? Actionable advice they could do today, this week, this month, to position themselves to start swimming upstream into doing larger deals.
Treat it like a business. You could start that today, and I think an actionable way to start is start putting together a business plan. What are the steps that you have to take to get a deal under contract? Reaching out to brokers, maybe starting a distribution list. Something that we recently started in the last couple of years: gifts, holiday gifts to brokers, just to stay top of mind and really build out that relationship. And then what are you going to do when you get the deal under contract? Just make a due diligence list of 10, 15 items. What are you going to do once you close? Make another list of 10 to 15 items and really start to systemize and compartmentalize those things. And not only is that going to help you in the future once you get to those points, I think that's going to give you a lot of comfort today in you being able to do it, because it might seem daunting to go from a duplex or a quad to a 20 or a 40 unit. But if you just put pen to paper, it just looks so much easier. And the reality is, I mean, it's not very difficult. It just takes persistence. It takes precision. But those are things that you could hone in. So I'd say today, just start treating it like a business, and stop just cruising Zillow and looking for the next opportunity. Because, well, what are you going to do if you get it today? Do you have the lending relationships in place? Do you have the due diligence relationships in place? Do you have the property management in place? And you can start building all that today.
Yeah, 100%. I mean, there's times where I feel like my brain is like short circuiting, and it's like, because you look at the mountain, right? And you neglect to think of the steps, the first step and then the second step, and just writing out and documenting that as if like you're writing out like a standard operating procedure for a company is really great. And also making a lot more, like, not only like reducing the anxiety associated with it, but also making it a lot more real in your mind in the process. So no, I love it. Um, so, Mike, how can our listeners learn more about you and also get on your distribution list?
Yeah, I'd encourage everybody to check out our website, nextplayinvestments.com. You could schedule a call with me there, sign up for our distribution list, and I'd be happy to chat.
Excellent. Mike, thanks for coming on for part two. Forward to doing a part three next year.
Thank you.
Take care.